Today we're looking at Expeditors International of Washington, ticker EXPD. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. They have a market cap of $16.7 billion, enterprise value of $14.5 billion, which means that they have $2 billion in net cash on this business. I really like to see net cash businesses. That is a good first sign. Operating in the air freight and logistics industry, this company provides logistics services in Americas, North Asia, South Asia, Europe, Middle East, Africa, and India, basically most of the world. Air freight services, air freight consolidation, forwarding, ocean freight, ocean services, order management, brokerage, ground transport, warehousing, distribution, customs clearance. Provides optimization, compliance, cargo solutions as a freight consolidator or agent for the airline, which carries the shipments. So they're not actually having to carry the shipments themselves. It also provides ancillary services, preparation of shipping, customs documentation, includes retailing, wholesale, electronics, technology, and induction. Wow. So quite interesting. This is a beta 0.92, so nothing extraordinary there. Share turnover seems normal for an S&P 500 company. I am interested in understanding how much of the freight work they're doing themselves and logistics versus some of the other kind of service is on top of that. Either way, sounds like a very interesting business that I hadn't heard of before. Return on invested capital. Now, immediately when I see this chart, I get excited. Few reasons here. The first thing you can see is you have 20 straight years of profitability. Anytime you have 20 straight years of profitability, that's a very, very good sign. You love what you see there with that. In addition, you see that this return on invested capital chart is hovering around the 20% line. I really like to buy businesses with a return on invested capital of 10% plus. Once you start getting in the 20% range, you're at a very attractive level because that means that you can achieve returns on equity of 15 to 20% without the use of any debt leverage, which gets very, very exciting. And we can see that every year since 2015, starting in 2015 with 25% return on invested capital, they have maintained a return on invested capital above 20%. So 25%, 24, 25, 31, 26, 25, and 40. These are world-class numbers. You really like to see this business. Also, from year to year, you see very strong stability. I mean, look from 2006, 22.86, 22.77, 22.61. You don't see any cycles here. There's not any sort of cyclicality in this business, so it gets very good numbers, and they're very reliable and predictable going forward. Love what I'm seeing there from that business. Now, you can also see this play out on the 10-year median returns, 25.2% return on invested capital, 25.6% return on equity. You can see that lack of needing debt leverage in the business because these numbers are already phenomenal. Also, what you can see is these numbers exceed your revenue growth rate, your asset growth rate, your free cash flow growth rate, and your EPS growth rate. What that tells you is they can internally fund their business without having to bring on new debt and without having to bring on additional equity. So they're not going to have to dilute you. They might. We'll see if they have a history of that shortly below. But they don't need to dilute you and they don't need to raise debt in order to grow. Very, very good sign that they can internally fund their growth, something that you'd want to see in a compounding type business. On top of that, despite growing revenue at 10%, assets growing 2%, and EPS at 16% over the last decade, they still have a PE ratio of 10. That's a very attractive number, and it matches up decently well with our return on equity with this price to book. Now, price to book is a little bit higher at a price to book of, let's call it 5. So it would suggest that you should have an earnings yield somewhere in that 5% range instead of a 10% range. So maybe earnings are slightly overstated. We're going to have to do a deeper dive there. But when you look at EV to EBITDA numbers, EV to EBIT, EV to free cash flow, all of these are very attractive, very reasonable numbers in that $7 or in that 7 range. So attractive valuation. I like to buy good companies at a PE of 15 or less. This one looks even more attractive, hovering around a 10 number. Once you get to the 10 number on a PE, you don't really need a lot of growth to justify the business. When you can combine a PE of 10 with a growth rate in the double digits, you start to get very, very attractive as a potential investment. So we need to do some deeper dive here as we go down to some of the financials. You can see that the revenue has basically tripled over the course of a decade from that $6 billion range to the $16 billion range. Very good returns there. What's interesting as well, it looks like they were a beneficiary of COVID because their business skyrocketed in 2020 and 2021. 20% growth, 72% growth. That might not be sustainable going forward. So one thing we'd want to look at is, are they going to drop back to this $6 to $8 billion range on revenue because you can see the difference it made. Gross profit tripling from 700 million to 2.1 billion is a significant deal, when before that they were more in the $1 billion range, which would be not nearly as good in terms of your profitability. They also saw some gross margin expansion and the operating profit margin expanding as well. So that operating leverage is very helpful to turbocharge that revenue growth into EPS growth. You can see the EPS growth here that just looks phenomenal. $1.57 to $8.27. That's more than a 4 to 5x over the course of a decade. Anytime you see this sort of growth rate, this 15% plus EPS growth rate, if that's repeatable, which we don't know yet, and it would require further analysis, it's something that's very attractive, makes for a very strong business case as an investor. Even if you just go, $1.57 to $3.39, so you're doubling in more than 7 years or less, more than doubling in 7 years. That's a very good number to see, because it means you're growing in the double-digit range, 10% plus. So from 2012 to 2019 is what we're seeing there. They're also achieving this while paying out a decent amount of your dividends. I mean, you see dividends here is about a third of 2020 numbers, about a third of 2012 numbers, and a third of 2019 numbers. That's good. Again, you can pay out a nice growing dividend when you have such high returns on capital and still fund your growth. So one of the things we're going to check next on the income statement, are they truly self-funding their growth? Are they doing that in the balance sheet? But before we get there, hit that like button. Don't forget to subscribe. I'm covering every company in the S&P 500, and you should stay tuned. So income statement is next. As we dive on in here, I really like seeing it. Look at this SG&A number is really, really low. I mean, SG&A is functionally zero compared to the types of gross profit numbers you're seeing. Your operating expenses are pretty low. A lot of the cost are in the cost of goods sold. Again, some of this could be, how they just distribute costs between various parts of the business. But I always like when I see a low overhead number. It's what allows growing gross profits to really drop to the bottom line and look really, really good. You can see that the net income has basically 5x'd over the course of a decade. Again, that's a really strong number. And not only are you not diluting, you are buying back shares. You've gone from 212 million shares outstanding to 171 million shares outstanding. That's about a 20% reduction in your shares outstanding over the course of a decade. That's pretty strong. You think about what that's going to do to you as a shareholder. It's going to give you an extra 2% boost per share to your profitability on an EPS basis than you would have on a net income basis. 2% is nothing to scoff at when it's going to improve your return over time by 2% per year. That's different between an 8% and a 10% annual return, 10%, 12% annual return. Both are very attractive numbers. Love what I'm seeing there, that they're doing steady buybacks. Now, balance sheet. You can see they're holding about $1 billion in cash. This requires very little PP&E. Look at this business. I mean, this is amazing. You have $500 million in PP&E to begin the decade, $1 billion in PPE to end the decade. There's almost no goodwill, no intangible assets. I mean, look at this asset base. 700 million. Let's call it $500 million, and yet they're earning $2 billion. I mean, this is the really phenomenal. This is why you're getting these 20 to 40% returns on invested capital, because there's very little capital needed to run into this business. Most likely, they're not owning these ships. There's almost no way this would look the same if they were just a normal shipping company. They're definitely hitting the more services side of this, and it looks really strong. I mean, you think about this, and they have twice as much cash as they do property, plant, and equipment. Very, very strong balance sheet. Do they have debt? There is no long-term debt on the business. Look at this liabilities line. No long-term debt, no short-term debt. You have some tax payable, accrued liabilities, deferred revenue. Accounts payables basically offset by your cash. They do have these capital leases, but still, those are fairly low numbers. I mean, 300, 400 million. It hardly changes the overall PP&E if those were owned businesses. Retained earnings matching your liabilities. I just love to see this clean balance sheet. This is what I would call a clean balance sheet. You have cash, you have some, short-term current assets, short-term current liabilities, but for the most part, there's no long-term liabilities, and any long-term liabilities are easily offset by cash. Very, very strong setup, very strong balance sheet. This is one of the strongest balance sheets I've seen in my set of analysis for the S&P 500 companies. Now, cash flow statement. You do see some stock-based compensation, which I find a little interesting because you're seeing the shares outstanding go down over time that requires these steady buybacks. But you can clearly see the buybacks more than exceed the stock-based compensation over time. Like for instance, 2015, $500 million in share buybacks versus $43 million in stock-based compensation. This number is going to be a little bit higher once you take into account kind of the dilution effects and how these are valued. But if it's $100 million versus $500 million, that's why you're seeing the shares decline over time. Your cash paid for dividends hasn't gone up that much. One of the things I find interesting here is let's look at this 117 to 196 number. Let's say it doubled from 2012 to 2021. But I want to go back and look at this overview. And so at the beginning you had, it's not going to show up the same way I thought it would, but 56 cents here, $1.04 here. That's about a double, but it's not as much. And so it doesn't tell the story I thought would here. But one of the things you can see is you're not having to spend that much on dividends because you're having that share buybacks. They're kind of reducing it by that 20% because you've done some buyback of those shares. I like that their capital is going totally into the buybacks more than the dividends. This complete lack of issuing debt, very strong sign. The business does not need debt to operate, so why would you have it? Just makes it a very secure balance sheet, very low amounts of PP&E investment. The depreciation and amortization is kind of in line with your PP&E investment, so it's nothing extraordinary there, no red flags. Altogether, this is a great looking stock that I'm very excited to have found. I'd never heard of Expeditors International before, but it looks very attractive to me, and so it's going to be an instant add to my watch list. I hope you've learned something from this video. Please hit the like button. Don't forget to subscribe. This is what I would call a high quality company at a great price. So I am very excited to do a little bit more digging and learning about this company going forward. I hope you will stay tuned. If you enjoyed this video, I think you will also enjoy some of the other companies that have made my watch list, and the playlist to that is going to be at the top of this video at the very end. And please subscribe. If you want to learn how to use this software, quickfs.net, you can get the affiliate link that I have in the description below. It is the first link in the description. I encourage you to check that out. Until next time, stop paying fees, start building wealth.